From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, May 23rd, 2025. Let's check the calendar. Your Milwaukee Brewers are in town for a real quick 3-game set with the Red Sox Monday, Tuesday, and Wednesday. Then they're back on the road. Monday is Memorial Day, and you can check out one of a million parades that are happening in the area. The U.S. Women's Golf Championship gets underway at Erin Hills this Wednesday. Elm Grove kicks off the beer garden season this Thursday. And if you're looking for something a little more interesting than that, there's goat yoga at Old World, Wisconsin. Let's start in Pennsylvania. A kindergartner from Johnstown brought Jell-O shots, yep, those kind of Jell-O shots, to school and handed them out to his kindergarten classmates. He's going to be the most popular kid in grade school. A Rhode Island man bought his wife an official Donald Trump watch as a birthday present. It cost him $650, but it may have been a knockoff. The first clue was the branding. It wasn't a Trump watch, but a rump watch, which is funny enough, but it says so right on the watch face, rump, R-U-M-P. One question, are you not supposed to wear that on your wrist? And finally, an interesting court ruling from Vancouver, Canada. A woman was bitten by a miniature Australian Shepherd dog. She sued the dog's owner for $4,000 and damages. She lost her case because the Canadian tribunal ruled every dog is entitled to one bite. It's true, Canadians are the nicest people. On the podcast today, we have Steve Giles, Tom Pappenfus, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Who's a good boy.
Thank you. Yeah. Not a great week overall. NASDAQ down 2.5%, closing at 18,737. That's 474 points in decline on the week. The S&P 500 down 156 points. That's 2.6% down on the week, closing at 5803. And the Dow Jones Industrial Average down 2.5%, closing in the week 41,603. Down 1,052 points after a 256-point decline on Friday. For the year, NASDAQ down 2.8, the Dow down 1.7, and the S&P down 0.9%. Steve, probably the perfect place to start. We went through felt like a pretty decent stretch of positive weeks, positive days. All of a sudden, I think we're getting reminded that we're not out of the woods on a lot of the conversations we've been having. A good reminder for investors that maybe got a little too excited about some market recovery that we got some more stuff to work through.
Yeah, I think you're right, Kyle. And this idea for those investors who are trying to, quote unquote, time things by playing, headlines with respect to earnings or headlines with respect to tariffs, that it's really hard to time just about anything in the market, and to focus instead on those longer-term objectives and goals that you have with respect to balance in your portfolio, and making sure that the way you put together your stock and bond allocation is appropriate for where you want to be, not next week or next month or next quarter, Kyle, but where you want to be 3 years, 5 years, 10 years from now.
Yeah, I don't think we changed the plan just because of a couple of headlines, right? Or just because of, one bad piece of news, one good piece of news. And I think there is a tendency to want to respond. But I think the reality is that unless something's changed about you, or unless we actually see something fundamental, that, it's counting on that plan, making sure you have balance.
I do think that a good takeaway for some investors over the last couple of months, what we kind of call the gut check, if you were worried about the recent volatility in the markets, perhaps you do need to revisit your allocation, and maybe the allocation you had at the beginning of the year was out of whack with where it might be now. And a good drop in the market is always a nice reflection for that stomach acid test in terms of your overall allocation.
And I think what better time to then make a change than after we've come back from those lows a little bit, right? You didn't respond. You waited out the pain. now that we've seen some recovery, well, okay, if it hurt too bad, then to your point, hey, let's reassess what the plan was. Tom, we got news late last week that the U.S. was, based on the third of the three major credit rating agencies, being downgraded from the highest level down to one rung below that highest level. It felt like at least kind of the immediate aftermath was some more market volatility, but also some response on the interest rate side. You now have a 30-year Treasury with a pretty attractive rate, depending on how you look at it, but certainly higher than we've seen. But what are you kind of looking at as you see kind of the interest rate move and maybe some of the causes and some of what investors should be thinking about it?
Yeah, I think it's one of those things with the downgrade in the rating. On the surface, it seems very ominous, very scary, but I think we all kind of agree here that U.S. is probably not in a worse position to pay its debts. I don't think that's necessarily a concern. To bring up a little bit of history, 2011 we had the downgrading from Standard & Poor's, and then we also had a downgrade in 2023 from Fitch. So what has the market done in that time? I think we've been okay for the most part. But it is kind of sending a signal, and you're seeing the bond markets react to that by basically the bond investors saying they're demanding higher yields to be buyers right now. So you've seen the 30-year here climb to a 19-month high, touching on 5% yield. And most notably, I think what we pay a lot of attention to is the 10-year yield. And it's hovering around 4.5%, I think just recently down just below 4.5%. I think, I was kind of studying some Morgan Stanley data, and they were looking back at what does that mean? What does recent history mean for kind of that level? And they kind of use that as almost a benchmark for, measuring where the market, how that might impact markets from here. And kind of, almost relating it back to, we've had this discussion before, but talking about earnings yield. You look at earnings now and valuations with valuation, the PE valuation right now is about 21.5, 21.8 times future earnings. So effectively meaning that for every $21.80 you want to buy in the S&P, you get $1 of earnings. When you divide that, you get about a 4.6% earnings yield. So that's not too different, Kyle, from the 4.5% you're getting on safe money. That's not real favorable to be an equity market investor at that level. So historically speaking, again, kind of going back to this Morgan Stanley piece I was reading, and they were talking about, going back to 2000, that's about as low as it gets before something has to change. And that either means that, well, you usually get some sort of valuation compression, or meaning valuations will go down, which can be one of two things. Well, either prices go down or earnings improve. And so it's just kind of whatever camp you may be in as to whether you think earnings are going to improve enough to see those valuations get a little bit more, let's say a little bit more like fairly valued, or you could be in the camp that you might see prices come down. And so it's just we're kind of in that point right now where we start to see the markets move in one way or another.
I think that earnings yield spread versus the 10-year Treasury yield is such an important concept to understand, because as investors, we have choices about what to do with our money. We can choose to buy stocks in the hope that they represent that the earnings we're thinking will materialize, that the growth that comes with being a stock investor historically is the reality that we face going forward. Or we can lock into that 10-year Treasury bond at 4.5% and be pretty confident that 10 years from now we'll have gotten that 4.5% a year. The comparison of, well, $1 into the Treasury is going to get you 4.5 cents. $1 into the S&P is going to get you 4.6 cents in earnings. That only tells you where earnings are going to be the next year. If we start to extrapolate that out a little bit further, we see some of the benefits of productivity gains from technology. It does miss out on the longer term growth, but I think it's important still to understand that 4.5% is a fairly, assumed at least, safe rate of return, and 4.5 is a lot more attractive than what we've seen in a long time relative to the earnings yield on the S&P.
Comes down to trade-offs. I mean, at the end of the day, do you want to be safe and make 4.5%, or do you, at those levels in the market valuations, you take more risk, and are you getting a whole lot more back for that?
And keep in mind, too, that historically rates have been very, very, very low. I think we need to reset investors' expectations as it relates to where yields are right now across the board, whether you're looking at the 2-year, the 10-year, or the 30-year. I mean, when I bought my house in 2001, I was thrilled to get 8.5% on my 30-year fixed mortgage. And I got clients who tell me they were thrilled to be in the low double digits when they bought their houses in the 1980s. So it's all relative. And I think U.S. investors, U.S. buyers have been a bit spoiled, Tom and Kyle, in the last 15 years, 12 years, because rates have been very, very low. I think long gone are the days of federal funds overnight rate being at 0 to 0.25%.
I hope that's the case, right? I hope that we don't go back to a universe in which that's what we're dealing with, because I think it brings all kinds of other challenges along with it. What's interesting to me is that much of the rest of the world sees far lower rates than we do. And so if we're talking about risk, going back to Moody's downgraded the U.S. one level to the rung below the highest rating. Well, most of the rest of the world wasn't AAA rated either, and you're getting far less yield on a 10-year German Bund or a 10-year Japanese yen-denominated government bond than you're getting here in the U.S., and yet, again, I think we're probably a little bit higher quality than a lot of other areas in the world. And so important to remember that there are some good yield opportunities out there, that they have come along for a reason, that relative to history, maybe it's not as high as it used to be. I very much have those conversations, Steve, of, mortgage rates up as high as they are now, it's a little more painful, but I think it does miss out on that historical context.
For retirees who rely on a significant portion of their portfolio to be in fixed income, they're thrilled that they're getting 4.5% on their bond funds.
And I think rightfully so when you consider that it was 1.5 or 2 going back 5 or 10 years. Joel, not a terribly busy week for economic news. I think we've joked in the past that you get kind of one fairly busy week and one fairly quiet week.
That was last week, and then next week is going to be busy again, too.
And a 4-day week to go along with it.
That's
so
right,
we're going to have to cram as much of it in as we can.
Yes.
But we did get at least a little bit this week on the economic front, starting early in the week with the survey of leading economic indicators.
You like to look at that one a lot. It's various components that the Conference Board, a private research group, follows, and they have an index that looks at all these components and how they perform. And based on that index, they can tell you whether the economy is doing well and whether it's not. It's doing a little worse in April than it did in March, according to this index. It went backward. It contracted at 1% in April, and as opposed to 0.8% in March. They also look at a 6-month span, and over the last 6 months, that index shows a shrinking of 2%, and that was equal to the 2% in the previous 6 months. So that's kind of the same, but it's still negative. It's showing negative growth in the economy. At the same time, the economists there say they're not seeing alarms for a recession, which 2 years ago, maybe it was even sooner than that, they were saying every month, there's a recession, we're going to have a recession, and we didn't have a recession. So it's a boy crying wolf, and eventually the boy's right? But not yet. And they're now saying, though, that the gross domestic product, which is a number we'll get next week in that busy week of government releases, that gross domestic product, which is the main measure of economic growth in the country, that's going to expand by only 1.6% in 2025, and that's as opposed to a 2.8% increase in 2024. And just for perspective, in February, the same group said that growth would be at 2.5%. So they went from 2.5% in February to now in April, 2 months later, saying 1.6%.
Joel, why the big downgrade?
They're just seeing more indicators from all of the indicators that they're looking at that are getting weaker. Everything from durable goods orders to the factory work week, how many hours factory workers are spending on the job, all sorts of things.
One of the things I like about the survey of leading economic indicators, for all the flaws and all the issues with all the indicators we look at, it's one that at least tries to give us some semblance of an understanding of where are things headed and what are the causes, what things are contributing to what we expect to happen going forward. And again, a lot of, I think, uncertainty in all of that data, as always, more so because of tariffs, more so because of some of the other pieces you just mentioned. But at least it is something that tries to predict the future a little bit.
Right, and another answer to your question, Steve, of why it's going down is consumer expectations. And next week we're going to have another measure, both from the Conference Board and from the University of Michigan, on consumer confidence and consumer sentiment. And we keep noting that consumers are saying that they are less and less confident in the economy, and yet we're seeing other numbers, hard numbers, that they're still spending.
I think there's an old Yogi Berra quote about how hard predictions are, especially when they're about the future. And so perhaps that's what we're looking at as we kind of navigate some of this, is that, it's harder than normal to maybe figure out where we're headed. We also had some housing sales data this week, going back, looking at April, and just kind of how unique the housing market has been over the last few months, and seeing some signs, some very positive signs in some places, and some signs that there are still concerns about inventory and prices as we continue to navigate that big part of our economy.
Right, yeah. So both the new housing and the existing housing are both at near record highs as far as prices, median prices, over $400,000, and those prices keep going up, especially for the existing housing. The existing home sales, now that's 80% of all the home sales in a year. And they went down another 0.5% in April. They're on an annual pace of selling 4 million houses this year. That would be down from 4.1 million in 2024, which was the lowest since 1995. So historically speaking, that's not looking good. And you're right, inventory is a lot of the problem. We went through the whole period after the Great Recession when we didn't build a lot of houses, and and we're paying for it now.
Yeah, and we're paying for it in the form of higher housing prices, right? That very literally we're paying for it because median home prices are up, and as you try to find things as a home buyer, it's hard.
Right.
And then last piece this week was unemployment insurance claims, and not a ton of noise there, not a ton of new information.
Yeah, that's been down 4 weeks in a row. We look at a 4-week moving average. It's the highest it's been since October, but it's still 36% below the all-time average, which started in 1967, which suggests that the employment market is still pretty tight right now.
Well, and if this goat yoga thing takes off, maybe some more jobs taking care of goats and herding goats as
cleaning up after goats.
Cleaning up after
yes.
goats, as Old World Wisconsin might need some help. So I'm always struck that an organization, an entity dedicated to the 1800s and early 1900s life in Wisconsin would promote a goat yoga, but it sounds like fun, and you might catch me there. So as always, we enjoy doing the program for you. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.